All right, good afternoon, everyone, and thank you for joining us today. I'm Ryan Bouchey, and I'm joined alongside my colleagues David Rath and Marty Shields, and we will be going through our quarter two webinar. Just a few brief housekeeping items before we start. Your computers or mics are defaulted to mute. Please just keep those on mute as we go through the presentation. And if you do have any questions or follow-ups after we go through our slides, please feel free to reach out to us. You could reach out to any of the advisors directly, or Harmony can direct any of your questions to us. So with that, why don't we begin and get into our second quarter webinar. So a lot of quarter two, a lot of the recent news and movement in the market seems as though it's been driven by, what's coming from the Fed and statements from the Fed. And we have right now the Fed leading the market. And, in a lot of ways, it reminds us in sort of an opposite direction, but going back to 2016 with the Fed beginning to raise interest rates and talks of rising interest rates being a headwind to the markets, and we saw about a 15-16% sell-off in the markets to start 2016 with fears of rising interest rates. But at that point, when you look at it, rising interest rates were meant to slow down a faster economy, stronger economy. And right now we're kind of seeing the opposite, where all of a sudden the prospect of lower rates are propelling the stock market forward. And so is that something that's going to last? Is it going to be something short-term in nature? Historically speaking, lower rates haven't always been the best thing for both the economy and the markets. But, so far it has been a big push and a big plus for the markets, especially in the second quarter. So if we look at it, we had a pretty strong April with, the folks who said sell in May, go away, unfortunately being proven right for the month of May. But ever since the start of June, we've had quite a run up in the markets. U.S. large caps really leading the way for the most part for the second quarter. If you kind of look at all the major indices, U.S. large caps led the way up over 4%. International developed actually did quite well versus international emerging market, which was relatively flat. But I do think probably the big standout, just from what we've seen and especially talking about interest rates, has been that bond index. And when you see, we saw over the last 4, 5, 6 weeks, the 10-year Treasury note, the yield on that dropped pretty sharply. And when you look at year to date, the U.S. bond index being up over 6%. Last year it was down for the most part for the year. It got to just about flat for the year right at the end and towards the end of December. But we're seeing a strong run in the U.S. bond index. Now, if you're a conservative investor or, a retiree that's more prone to saving, is lower interest rates a good thing, even though you get a boost in your market value in bonds? It's to be seen. But so far with a sharp decrease in overall interest rates over the past couple of weeks, we've seen the U.S. bond market really take off. And, quarter two was very strong. And for the year being up over 6% is a much different tune than we've seen over the last year or two, especially since interest rates began to rise going back to the end of 2015 and start of 2016. From our perspective in the portfolios, not much has changed since our last webinar. We continue to be overweight U.S. equities, technology sector, the financial sector, healthcare, and we added at the beginning of the year some more higher dividend paying stocks just to become a little bit more defensive in the overall portfolios, but without going to, cash or fixed income. We just wanted to be a little bit more defensive in our equity holdings and equities allocation of the portfolio. We continue to be underweight international equities and high volatility stocks as well. And, as we've seen so far year to date, U.S. markets continue to do well versus our international equity. So we continue to like the overall allocation. Like I said, as things continue to change or we go through the year, We may make slight changes to the portfolio. We won't overreact to any news, but as time goes on, we're always talking as an investment committee what's next and what we may do for the overall allocation. And so with that, I'm going to turn it over to Marty Shields. He's going to talk a little bit about all-time highs and where we go from here.
Thank you, Ryan. Good afternoon, everyone. So we want to talk a little bit about all-time highs. We hear this with clients when the markets hit all-time highs, that people get concerned that they should be getting out of the markets. And want to talk about really what that means to an investor when we hit an all-time high. Defying the laws. So I think people think of gravity when they think of markets hitting all-time highs, that whatever goes up must come down. So you have Sir Isaac Newton here getting hit in the head by the apple. But when you're talking about the markets hitting all-time highs, that is really not the case. When markets hit all-time highs, you may hit a time of volatility where they pull back for a little bit. But over time, markets trend higher. And as this graph illustrates, this is looking at the market performance since 1996. We hit different periods of highs back in 2000 and 2007, and then we hit all-time highs in 2013, and that trend has continued. And there could have been situations where it might have been appearing that a good time to get out of the markets because it looked like it was going to be a repeat of 2000 to 2007. But for those who stood pat and from our perspective, kind of looked at the data and stayed invested in the market, they benefited from staying in the market and kind of continued to hit all-time highs. When we look at some of the all-time highs that were hit since 2013, we actually have 206 times that the market hit all-time highs. And every year since 2013, we've had periods of time where the markets have hit an all-time high. And it's always the case when the market's doing that there's a talking head, a economic prognosticator that says, hey, I think the market's going to be crashing from here. And this is one of those. This gentleman, this is not more recent. This is actually from 2013 that this gentleman from Rosenblatt Securities said, that he feels that the market's going to be taking a real step back. And again, so we always kind of indicate that probably listen to the news and the headlines and CNBC, probably not a great way to get your news or manage your portfolio, because there's always somebody out there that's going to be indicating that the market's going to be dropping quite quickly. And I think this chart really sums up our perspective of what it means to be a long-term investor and what it means when the markets hit all-time highs, and even more from a period of time of where we stand when you look at the market history. So this is looking at the market performance back to 1900, so a very long time period. And what you see is the market actually moves in different trends, right? So the gray line is the actual performance of the market over time. The green line is the trend line of the market. The kind of dark gray bars, those are recessionary periods. And what you can see is that there are periods of time, like we saw right before around World War II, where we got the market's flat. We call those flat periods of time secular bear markets, right? And we actually just came out of one of those secular bear markets that started in the tech boom of 2000, and it has continued really until around 2012 or so. And that was over that period of time, the market was flat, and they can last anywhere from 8 to 12 years. But you can see that there have been a number of those periods. And then there's been a number of periods where the market's trending upwards, and those are secular bull markets. And you can also see that we've had a number of those. And from our perspective, we believe that we're in one of those secular bull markets now. And again, this doesn't mean that we can't get a pullback. We could have a recession. But in general, the trend line from our perspective for the market is going to be trending upwards. And when we hit all-time highs for the market, that should be something that's celebrated, not to be fretted. Okay, I'm going to turn it over to David Rath, and he's going to go through our economic outlook.
Thank you, Marty. It's good to have everybody aboard for this webinar, and I just want to go through a couple talking points regarding the overall economy. A lot of what I'm going to go over is really just a continuation of stuff that was discussed during our State of the Economy address at the beginning of the year, our Q1 webinar. These are things and trends that move fairly slowly. So it's really just kind of updating where we are now and where we would see it moving forward. So I feel like the camel in this cartoon represents a lot of investors, how they feel on a day-to-day basis. There's all this stuff that's weighing down. What's going to be that next straw that breaks the camel's back? So there's always going to be something, regardless of the time period, that shows there is something to worry about in the market. But as Marty pointed out earlier, markets over time tend to trend upwards and to the right. So just recently, we broke the record for the longest expansionary history from the end of the recession in 2008 into where we are right now. You can see the previous record was held in between 1991 and 2001. And so this is really not necessarily, this is more of a new phenomenon where these economic expansions are lasting for longer periods of time. You can see the shorter expansions, they focus in the 50s and the 70s, and there were some other economic factors at work, but more recently what we've seen is more of these long, slow, drawn-out recoveries. And that's really illustrated in this graph right here, showing that from 1950 on, the general pace of recoveries has slowed with each economic expansion. So the expansion that we've seen up till now has averaged about 2.3% per year. And I think that given the demographics in this country and where we are in relation to the age of our economy, we are a developed economy that is not subject to the same type of growth potential that you might find in a newer economy. We're probably going to see more of this throughout history, which is these long, slow, drawn-out recoveries. And this is not just in the United States. So the blue line here represents our current recovery and where we're at, and then the other two colors represent the Eurozone and Japan, two of the other developed areas in the world that everybody's aware of. So their recovery started more recently due to some recessionary periods in those economic blocks, but as you can see, the pace of expansion is pretty similar to what we've seen in this current expansionary environment. Now, this chart is a little busy. I want to take a second to describe what's going on. On the left-hand side, you can see an overlay of the Citigroup Economic Surprise Index, represented by the blue line. And the chart on the left is between December 2015 and March 2017. And the yellowish line is the S&P 500 overlaid. And you can see that there's a fairly high correlation between economic surprises being good, S&P 500 going up. And that stands to reason, because usually good economic news means that the economy is growing, the market responds in kind. However, that has changed somewhat in the last couple months. So you can see the correlation is actually a negative 0.57 between the two things. We saw this most recently when the good jobs market, the good jobs report for June came out, and the market reacted somewhat negatively. And to some people that could be a little surprising, but essentially what's going on is we're pricing in some stimulus in the July meeting from the Federal Reserve, and if better news than expected comes out, we might not see the same amount of stimulus that we were expecting. So I think that's what's going on right now is the market is pricing in some stimulus, and good news might equal bad news for stock prices in the short term. This is an update to a chart that we went through at the State of Economy. So as you can see, there's still a decent amount of green representing strong levels or improving trends on this chart. So I think with the last couple slides and some that we're getting into, we're pointing out some caution areas, and I think that overall things are still strong. The GDP numbers are still positive. However, we are keeping our eye on some things that do stand to take an additional look at. Now, this represents the countries in the global economy with a PMI below 50. For those of you who read the quarterly newsletter, I explained the PMI. Essentially what it is, it's a survey of decision makers at manufacturing companies. This is the manufacturing PMI. And what their plans are for hiring, what their plans are for capital expenditures, really gives a barometer of what manufacturing activity is going to look like in the future, because these are the people who are making those decisions with money for the manufacturing sector. So as you can see, the number of countries with a PMI below 50, and 50 represents the line of demarcation. Anything below that represents potential contraction. So PMI below 50, we've right now hit a number that we haven't seen since the 2011 to 2013 period, with countries having a PMI below 50. But at the same time, it's not the end of the world. As you can see, there have been other periods of time where that manufacturing PMI number has dropped below that 50 spot within the current expansionary environment, and then we've rebounded out of it. So it's not to say that it's going to portend really bad times or a recession or anything like that, but it is something for us to be aware of. This represents the expectations for CFOs around the world. Again, this is similar to that PMI index, where we're seeing what these people who are in charge of the money, what they're expecting from here on out. And they are, a good majority of them are expecting a recession either by Q2 of 2020 or by the end of the year 2020. Again, with anything else, it's existing in the future, and we don't really know what the next couple months or the next year or so is going to hold. But it is a good thing to point out where the people who are in charge of making these decisions, they are not overextending their balance sheets. And so if they're worried about an upcoming recession, they might not be taking on that extra load of debt that they might not be able to meet those obligations. So you can really look at this chart two ways. One, that people are being a little cautious, and the other, that maybe there is a recession around the corner, but unfortunately we just don't know that in advance. The yield curve is something that we've discussed, and we discussed it at length in the last podcast. As you can see, the yield curve, which is represented by the yield on the 10-year minus the 3-month yield, has been negative for some time now. And as you can see in the past, that does usually portend a recession. The challenge, of course, is that it's not always going to give you a 100% clear signal, and it's also impossible to time when that's going to happen. So this is something that everybody's aware of, and it's something that we obviously watch on a day-to-day basis. But it's unfortunately, just like anything else, it's impossible to time these movements. So we could really see the market go up from here based on some of the charts and data that we've seen before in this podcast. But there is something that's showing us that maybe there are some tougher times around the corner. Now I'm going to turn it back over to Marty. He's going to discuss some portfolio positioning within our current allocation.
Thanks, David. So this is our last section here, and we just wanted to go through and highlight a few items in regards to the portfolio and how we have them positioned and the reason behind that positioning. So as Ryan mentioned in the beginning of the presentation, over the last year or two, in particular the beginning part of this year, we've begun to make the portfolios more defensive, in particular as far as the holdings for our equities. And what that really means is we're moving more out of growth and high volatility stocks and more into value and dividend paying stocks. And there's two reasons for that. One is in times of volatility, dividend paying stocks tend to do better. They tend to have less of a drawdown than growth stocks or high volatility stocks. And that's going to be important to smoothing out the performance of the portfolio. And the other reason, is a very important reason that this graph shows, is overall performance. So what this graph does is it looks at the performance if you put $10,000 in 1970, and if you put it into the S&P 500 and just got the price return, so no dividend reinvestment, but just the price return, that is the red line. And that $10,000 would be worth well over $200,000 as of January 2019. So great return, really good performance, and it shows the value of being a long-term investor. But if you were to go ahead and include the dividends in that performance and the reinvestment of those dividends, that $10,000 would be up over $1.4 million as of January 19th. So although price appreciation is very important to an equity investor, dividends and the reinvestment of those dividends is as important. And with these higher paying dividend ETFs that we're using, you're getting a dividend yield anywhere from 3.5% to 4%, which is above what you're going to be getting with the S&P 500. So again, the reason for becoming more defensive is better positioning for volatility and also higher income through those dividends. One of the sectors that we're overweight that Ryan mentioned is healthcare. And unfortunately, it has not been one of the strongest performing sectors this year. Last year had a very good year, but we still believe very strongly in that sector and the investment thesis behind it. And these three graphs help illustrate that. This first graph on the left-hand side, upper corner, shows the demographics that are going to be have occurred and are going to be occurring in the U.S. And it looks at two age groups. One is those individuals over 65, and that's the blue line, and then the green line is those individuals over 85. And what you see is in both those cases, they're becoming a larger part of the U.S. population. And in particular, those individuals over 65, over the last 5-6 years, and as we move forward over the next 10 years, that group is really growing quite a bit. It went from just over 10% to almost up to 25% by 2040. So this is the baby boomers, and these folks are retiring, and they're going to be using a lot more in the healthcare space. If you go over the right-hand graph over here, you'll see that for each of these demographics, age 45 to 64, 65 to 74, and age 75 and over, how often they go to a physician visit 4 times or more a year. And what you can see, and this is no surprise, that as you increase in age, the percentages of individuals going to the doctor 4 or more times increases, which is what you'd expect. And then the healthcare spending by those age groupings is quite dramatic, right? So you go from as low as just over $3,000 for those, this is annual spending for those individuals under 18, and it increases all the way up to almost $35,000 annual spending for those individuals over 18. So if you put the two of these together, which is this dramatic increase in these in individuals in the U.S. who are in these age categories and the spending for each of those categories, it is easy to reason that healthcare providers are going to see an increase in revenue and an increase in profit. And therefore, that's the reason we still like this sector. And then finally, we just want to hit on our underweight to international or overweight to domestic equities. And we've had this overweight to U.S. equities relative to international equities probably for about 4 or 5 years now. And what this graph shows is that has been a good decision. The blue line is basically showing the performance of international U.S. to equities relative to international equities. And right here at 100, anything below 100 means international equities are outperforming U.S. equities. And so you can see in the 2000s, from about 2002 on for a little bit of period of time, international equities actually were outperforming U.S. equities. But then that trend changed. And over the last 10 years, it's just been the opposite. U.S. equities have outperformed international equities. And from our perspective, this trend could change at some point, but we actually still feel very strongly that when you look at what's going on over in Europe and some of the other developed countries, that this trend could continue for at least another year or two. So we're going to still be strong believers in being overweight in U.S. equities and having that. But again, at some point, we may make a decision to change that and go back to target with international equities. Well, folks, that concludes our presentation. We appreciate you spending the time to listen to it. Hopefully you found it to be beneficial. And as Ryan said, if you have any questions, please feel free to email us or call us with those questions. And we will be putting a copy of this presentation out on the website within a day or two. Thank you very much. Take care.